Every investor dreams of building wealth. But when most people enter the stock market, they quickly discover a confusing world. There are endless choices: mutual funds, hedge funds, exchange-traded funds, stock tips, and promises of quick riches. Financial news shouts about hot stocks to buy today and urgent warnings about crashes tomorrow. The result is noise, and for the average investor, noise leads to mistakes. John C. Bogle, the founder of Vanguard and the pioneer of index funds, believed that investing should not be about chasing the latest trend. It should not be about gambling on luck or paying high fees to professionals who often fail to deliver. Instead, investing should be grounded in common sense. It should be about owning businesses, holding them for the long term, and letting compounding quietly do its work. This book is his gift to ordinary people. It strips away the illusions and complexity that the financial industry loves to sell, and it reveals the simple truth. The stock market is not a casino where you must play games to win. It is a mechanism to share in the growth of businesses and the economy. If you stay patient and minimize costs, you can capture that growth for yourself. But how do we see this truth clearly when the world of investing is filled with distractions? Bogle begins with a simple story. A parable that shows us what really happens when investors chase excitement and why the financial industry always seems to win while individuals often lose. This story lays the foundation for the entire book, leading us to the first lesson in common sense investing. Now let us enter Chapter 1. Chapter 1. A Parable. Imagine a grand party in a beautiful hall. The tables are set with shining plates and crystal glasses. In the center of the room lies a giant pie, fresh from the oven, warm and delicious. This pie represents the total return of the stock market. It is large enough to feed everyone. Every guest at the party, representing investors, is invited to share. At first, the mood is cheerful. The pie is growing because businesses are working hard, earning profits, and expanding. Everyone feels confident that they will leave with a full plate. But something strange begins to happen. Before ordinary investors can take their slice, several waiters step forward. These waiters represent fund managers, brokers, analysts, and other middlemen. Each one slices off a piece of the pie for themselves. A broker takes a slice as commission. A fund manager carves out another slice as a management fee. The tax collector quietly walks up and claims his portion too. Little by little, the pie that was once large begins to shrink. When the time comes for the ordinary investor to collect his share, he finds that his portion is much smaller than expected. This is the hidden truth of investing. The stock market itself gives generous returns over time. Companies grow. Dividends are paid. The pie expands naturally. But by the time trading costs, fees, and taxes are deducted, the investor's slice has been eaten away. This parable is not a fairy tale. It is the daily reality of millions of people who put their trust in expensive funds and complex strategies. John Bogle uses this story to teach us a simple lesson. If you want to keep more of the pie, you must reduce the number of hands that touch it. That means minimizing fees, avoiding unnecessary trading, and focusing on long-term investing. The market itself is productive and rewarding, but the financial industry around it often drains more value than it creates. Think of it this way. If you invest in a fund that charges high fees, it is like inviting a greedy waiter to cut your slice before you taste it. If you trade often, paying commissions and taxes, it is like allowing more strangers to nibble at your plate. Over decades, this constant nibbling reduces your wealth dramatically. On the other hand, if you buy and hold the market at the lowest cost possible, your slice stays intact. The compounding of returns works fully in your favor. This parable also highlights a paradox. Investors as a group must, by definition, earn the market return. If the stock market grows by 10% in a year, all investors combined receive that 10% before costs. But after fees, expenses, and taxes, the average investor receives less. This means the financial industry as a whole takes billions of dollars that could have belonged to investors. It is like a casino where the house always wins. The only way to win as an investor is to refuse to play the costly games, and instead stick to the simple act of owning the market. Bogle's parable is not meant to scare us. It is meant to awaken us. The truth is liberating. Once we understand how the pie is divided, we can choose to protect our slice. We can step away from costly funds and brokers and instead invest directly in low-cost index funds. These funds are designed to keep expenses tiny, taxes minimal, and results closely tied to the true growth of the market. The beauty of this lesson is that it requires no special talent, no prediction skills, and no insider information. It is based on common sense. Own the market. Keep costs low. Stay the course. That is the parable's wisdom. And this leads us naturally to the next idea. If markets really do provide steady growth, if the pie itself keeps expanding, then why do so many investors still chase short-term excitement and hype? In the next chapter, Bogle introduces the concept of rational exuberance. It is about finding joy and confidence not in speculation, but in the simple act of long-term ownership. Chapter 2. Rational Exuberance. In the world of investing, we often hear about bubbles, manias, and irrational exuberance. These are times when crowds lose their sense, chase soaring prices, and believe that markets will only go up forever. History is filled with such moments. From the tulip craze in 17th century Holland to the dot-com bubble in the early 2000s, human beings have again and again shown their weakness for wild speculation. The results are always the same. A few people get rich quickly, but the majority are left with broken dreams and empty pockets. John Bogle asks us to consider the opposite approach. Instead of irrational exuberance, what if we embraced rational exuberance? What if our excitement came not from gambling on short-term moves, but from the steady and almost certain growth of businesses over decades? Rational exuberance means trusting the power of capitalism itself. It means taking joy in the fact that millions of men and women wake up every morning, go to work, invent, produce, sell, and earn profits. As long as human energy and creativity drive economies, businesses will grow. And as long as businesses grow, shareholders who own them will share in that prosperity. Think about the math of long-term investing. If a company increases its earnings year after year and pays dividends along the way, the value of that company's stock will reflect it in the long run. 1 year of poor performance does not matter. A sudden drop in prices does not erase the value of decades of growth. What matters is the continuous upward pull of business profits. Rational exuberance is about celebrating that long-term trend instead of getting trapped by short-term noise. Bogle also reminds us that markets are human creations. They reflect not only profits, but also emotions, fear, and greed. Prices move every second, but the true value of a business changes slowly. Rational investors do not confuse the ticker tape with reality. They understand that in the short run, the market is a voting machine, driven by popularity contests. But in the long run, it is a weighing machine, measuring the real weight of corporate earnings. This idea, borrowed from Benjamin Graham, is central to Bogle's philosophy. When you think rationally about the stock market, you see it as a living engine of growth. Businesses create goods, services, and jobs. Investors provide the capital that fuels this cycle. Everyone benefits when costs are kept low, and ownership is spread widely. Exuberance in this sense is not foolish. It is wise, disciplined, and deeply optimistic about human progress. But rational exuberance also has a warning built into it. It tells us not to be blind to risks, but to accept them in a balanced way. Stocks go up and down, sometimes dramatically. But over the course of a lifetime, they reward patient investors who stay invested. The danger is not in the volatility of the market. The danger is in the impatience of the investor. Rational exuberance requires faith in the future, courage to hold on during declines, and discipline to avoid speculation. Bogle's vision is simple yet powerful. By owning the market through a low-cost index fund, you automatically share in the success of thousands of businesses. You become a partner in human progress itself. Every innovation, every factory built, every new product launched adds to your return. That is something to be truly excited about. As this chapter closes, we now understand why long-term optimism, grounded in business reality, is the foundation of investing. But the next question naturally arises. If the market is a reflection of business, and if businesses are the source of all real wealth creation, then how should we align ourselves with them? How do we place our lot with businesses instead of getting lost in market speculation? This takes us directly to the next lesson. In Chapter 3, Bogle explains why we must cast our lot with business. Chapter 3. Cast your lot with business. Imagine for a moment that the stock market vanished tomorrow. No trading screens, no daily news flashes, no brokers shouting buy or sell. Would the value of businesses suddenly disappear? Of course not. Companies would still be producing cars, building houses, selling food, and providing services. People would still go to work every morning. Factories would still hum. Stores would still open their doors. The reality of business continues whether the market exists or not. This is the truth John Bogle wants us to see. The market is only a mirror, sometimes a distorted one, reflecting the real activity of businesses. In the short run, that mirror can be foggy or cracked. Prices can rise far above reality or fall far below it. But in the long run, the reflection becomes clearer. The true value of any stock is the earnings it generates and the dividends it pays. Over time, stock prices follow these fundamentals like a shadow follows the body. When you cast your lot with business, you are choosing to own the productive power of companies, not the emotions of the market. You are saying, I believe in the long-term growth of human enterprise. I do not need to gamble on timing or trade based on rumors. I will simply own the market itself, because the market is nothing more than the collection of all businesses. Consider this. If you try to outsmart the market by buying and selling, you are betting against other traders who are just as eager as you. It becomes a zero-sum game. For every winner, there is a loser. But when you simply hold the market, you step outside that costly game. You no longer need to guess better than others. You simply collect the return that businesses deliver. That is a winner's game. Bogle uses history to prove his point. Over decades, stock markets around the world have risen. There have been wars, recessions, crashes, and panics. Yet, over the long sweep of time, businesses survived, adapted, and grew. The compounding of profits and reinvested dividends has always rewarded patient owners. To cast your lot with business is to join that patient group of owners. The alternative is to cast your lot with speculation. Speculation means betting on price changes instead of real value. It is like betting on the next wave of the ocean instead of trusting the steady tide. Waves crash, swirl, and disappear. The tide always comes in. Businesses are the tide. Speculation is just the foam. But Bogle also gives us a warning. While the market as a whole is reliable, individual stocks are not. Companies can fail. Giants can collapse. Industries can shrink. That is why his advice is not to put all your money in one or two businesses, no matter how strong they look. Instead, own them all through a broad index fund. In this way, you share in the growth of winners while avoiding the full risk of losers. Casting your lot with business is not glamorous. It will not make you rich overnight. It may feel boring compared to the excitement of trading. But it is the surest way to build wealth with dignity and peace of mind. It is a strategy built on trust in productivity, discipline in costs, and patience over time. And here lies the turning point. If the market is indeed a winner's game, built on the foundation of business growth, then why do so many investors fail to win? Why do they fall behind, even when the market itself does well? This is the puzzle Bogle tackles next. In Chapter 4, he reveals how most investors turn a winner's game into a loser's game. Chapter 4. How most investors turn a winner's game into a loser's game. The stock market is a winner's game by design. Over time, businesses grow, profits rise, and the market as a whole delivers positive returns. Yet, most individual investors manage to turn this obvious advantage into a personal disappointment. How does this happen? John Bogle identifies a pattern that repeats again and again. It is the combination of impatience, overconfidence, and the costly habit of chasing short-term performance. Many investors are drawn to the glamour of big gains. They read about a fund manager who has beaten the market for 3 years in a row. They hear stories of a stock that doubled in 6 months. Excitement builds. The investor jumps in, hoping to capture the same magic. But what is overlooked is that past performance is no guarantee of future results. Often, today's hot stock or fund becomes tomorrow's underperformer. The second way investors lose is by frequent trading. Every buy and sell triggers commissions, spreads, and taxes. These costs may seem small individually, but over time they compound against the investor. A 10% gain can quickly be cut to 5 or less once trading fees and taxes are accounted for. Ironically, those who are most active, believing they are clever, often end up with the lowest net returns. Third, investors are prone to emotional mistakes. When markets soar, they become greedy and take on more risk than they should. When markets fall, they panic and sell at the bottom. Fear and greed distort decisions. Investors forget the parable of the expanding pie. They focus on price swings instead of the real value of businesses. By reacting emotionally, they turn a long-term winner's game into a personal loser's game. Bogle emphasizes that these mistakes are not due to lack of intelligence. Smart people make them every day. The problem is structural. The financial industry encourages trading, hypes hot funds, and markets complex strategies. Ordinary investors are caught in this system. They follow the crowd, pay high fees, and constantly second-guess themselves. In doing so, they subtract from their own potential gains. The solution is clear. Avoid the traps that lead to losses. Stop chasing performance. Stop trading excessively. Focus on long-term ownership of businesses through low-cost index funds. Let compounding work in your favor instead of against you. By doing so, you reclaim the natural advantage of the market as a winner's game. History shows that patient, disciplined investors consistently outperform those who chase quick gains. The numbers are not biased. Costs, emotions, and impatience are the true enemies of wealth accumulation. By avoiding these, you place yourself on the path of rational investing. And this naturally brings us to the next principle. If the key to winning is avoiding costs, then a central question arises. Which investments carry the lowest cost, and how can we focus on them? In Chapter 5, Bogle dives into the importance of focusing on the lowest cost funds. The answer to sustainable wealth lies not in chasing returns, but in protecting them from fees and expenses. Chapter 5. Focus on the lowest cost funds. Imagine 2 travelers on the same road to wealth. One carries a heavy backpack full of stones, representing fees, commissions, and expenses. The other carries nothing but essentials. Both start at the same point, walk the same distance, and aim for the same destination. Who arrives with more energy and resources? Clearly, the traveler with the lighter load. This is the essence of John Bogle's advice about investing. Costs matter more than almost anything else. Every year, mutual funds charge management fees. Brokers collect commissions. Hidden administrative expenses take a small but steady bite. Individually, they seem minor. 2% a year may appear harmless. But over decades, these costs compound against the investor. A simple calculation shows that a fund charging 2% per year can reduce your long-term wealth by half compared to a fund that costs only 1/10 of that. The effect is dramatic and unavoidable. Bogle stresses that trying to beat the market through active management is rarely worth the extra cost. Even the best managers cannot consistently outperform the broad market after fees. A low-cost index fund, on the other hand, tracks the market return with minimal expenses. It does not promise to be spectacular, but it reliably captures the growth of the market itself. Over time, this simple approach outperforms the majority of active funds. Focusing on costs is also a test of patience and discipline. Investors must resist the temptation to chase hot funds or frequent trading strategies. These often have higher costs disguised as opportunity. The lower the cost, the more of the market's natural growth stays in your pocket. Small differences in fees make a huge difference when compounded over decades. Bogle also introduces the idea of parsimony in investing. Parsimony means carefulness with every penny spent on fees and taxes. Investing is not about glamour, complexity, or clever tricks. It is about building wealth steadily, quietly, and efficiently. By focusing on the lowest cost funds, you reduce friction that slows your journey. You allow compounding to work fully. You let your slice of the market pie grow undisturbed. The beauty of this principle is that it is simple, accessible, and universal. Any investor, anywhere in the world, can follow it. You do not need special skills or insider knowledge. You do not need to predict market movements. You simply choose the lowest cost funds that give you broad market exposure, invest consistently, and hold for the long term. This is the secret that has created wealth for millions quietly, without headlines or hype. And there is one more aspect that Bogle emphasizes. Costs are not only about management fees. Hidden costs also include trading within the fund, tax inefficiency, and unnecessary complexity. Every extra layer eats into your returns. The fewer the layers, the more of the market's growth belongs to you. This leads us naturally to the next principle. Once we focus on minimizing costs, the next question becomes clear. How do we maximize the other side of the equation, the source of growth itself? Bogle reminds us that dividends are not just numbers on a statement. They are the steady engine of compounding returns. In Chapter 6, he explains why dividends are the investor's best friend. Chapter 6. Dividends are the investor's best friend. Imagine planting a tree in your backyard. Each year, it grows a little taller. But the real magic comes when it begins to bear fruit. The fruit feeds you, nourishes your family, and allows the tree to continue growing stronger. In investing, dividends are like that fruit. They are the tangible, recurring reward that companies pay to shareholders for their ownership. Bogle calls dividends the investor's best friend, and for good reason. Dividends are the most reliable source of long-term investment returns. Historically, a significant portion of the stock market's total return comes from reinvested dividends. When you receive a dividend and immediately reinvest it in the same company or fund, it starts to compound. Over decades, this compounding effect becomes extraordinary. Small dividends today can grow into a substantial portion of your wealth tomorrow. Bogle emphasizes that many investors ignore dividends at their own peril. They focus only on price changes or speculate on stock growth. But the price of a stock fluctuates daily, often driven by emotion, rumors, or short-term sentiment. Dividends, on the other hand, represent actual profits distributed to owners. They are a concrete reflection of the business's success and its commitment to shareholders. Consider two companies. One reinvests all its earnings without paying dividends. The other pays a consistent dividend while maintaining growth. Which one will reward the long-term investor more reliably? Historically, the dividend payer often outperforms because dividends provide both income and compounding power. They act as a steady engine even during turbulent market times. Another benefit of dividends is psychological. Receiving regular payments reinforces the value of patience. Investors see tangible results from their ownership, rather than chasing volatile price movements. It builds confidence, discipline, and the understanding that wealth grows steadily, not in sudden bursts. Bogle also warns that ignoring dividends can distort perception. A stock may rise sharply in price, creating the illusion of extraordinary returns. But without dividends, much of the real growth is missing. Dividends reinvested over time create the wealth that truly matters. This is why focusing on dividend-paying investments, or dividend-rich index funds, is central to a long-term strategy. Dividends, combined with low-cost investing, create a powerful synergy. Costs eat away at returns, but dividends rebuild them steadily. Dividends act as a buffer, protecting the investor from volatility, while compounding magnifies wealth over decades. This combination is far more effective than chasing short-term gains or expensive active management. As this chapter closes, we see a clear pattern forming. Investing success is not about speculation, short-term excitement, or clever timing. It is about steady ownership, low costs, and the disciplined reinvestment of dividends. But not all investors understand this. Many are misled by illusions of skill, hype, and market predictions. In the next chapter, Bogle explores the grand illusion of thinking that fund managers can consistently beat the market. Chapter 7. The grand illusion. Many investors believe they can consistently pick winning funds or stocks that outperform the market. They watch the performance tables, read reports, and hear success stories of star fund managers. It feels possible. It feels real. But John Bogle calls this belief the grand illusion. The truth is harsh but simple. For most investors, trying to beat the market is a losing game. The illusion is rooted in three ideas. First, past performance does not predict future results. A fund that soared last year may stumble this year. A manager who outperformed for 5 years may fail in the next 5. Second, the costs of investing erode any advantage. High fees, trading costs, and taxes make it almost impossible for active managers to consistently outperform. Third, the market itself is efficient. Stocks are priced based on all available information, meaning opportunities to beat it are rare and fleeting. Bogle uses simple numbers to illustrate this. Suppose an investor chooses a fund that beats the market by 1% annually before fees. If the fund charges 2% in management fees, the investor is actually losing 1% compared to a low-cost index fund. Multiply this over decades, and the difference is staggering. The illusion of skill vanishes under the weight of costs. Investors often fall prey to what Bogle calls performance chasing. They look at the hot fund of the month, or the stock that doubled in price and jump in. By the time they invest, the fund's good luck is over. Meanwhile, the market keeps moving steadily, compounding returns for those who simply held broad exposure. Chasing winners is costly and psychologically exhausting. Bogle emphasizes that the grand illusion is not a moral failing. Smart, diligent, and informed investors fall into it constantly. It is a structural problem in how investing is presented. Financial media, marketing materials, and even advisors often highlight short-term success stories. The result is a population of investors who believe skill, timing, or clever strategies are keys to wealth, when in reality, patience, simplicity, and low costs are the true drivers. The antidote to this illusion is discipline. Recognize that the market as a whole grows over time. Accept that beating it consistently is extremely unlikely. Focus on low-cost, broadly diversified index funds. Ignore the noise. Stay invested for the long term. In this way, you step out of the illusion and reclaim control of your financial future. And there is another layer to consider. Even when investors recognize the illusion, they still face costs hidden in taxes. Paying attention to taxes is essential because they reduce the gains the market provides. In the next chapter, Bogle explains why taxes are cost too and how they quietly erode returns if ignored. Chapter 8. Taxes are costs too. Many investors focus on fees and fund expenses, but they often forget another silent thief: taxes. John Bogle reminds us that taxes are just as important as explicit costs. Every dollar paid in taxes is a dollar that cannot compound over decades. While fees slowly erode wealth, taxes can strike suddenly, often at the worst possible moment. Consider short-term trading. Selling a stock held for less than a year usually triggers a high tax rate on gains. Even if the investment performs well, the profit shrinks once taxes are applied. Frequent traders may feel clever capturing short-term opportunities, but in reality, they are handing over a significant portion of their wealth to the government. Meanwhile, long-term investors who hold and reinvest dividends benefit from lower capital gains rates, allowing compounding to work fully. Bogle emphasizes that index funds are naturally tax efficient. Because they trade very little, they generate fewer taxable events. There is no constant buying and selling inside the fund, and fewer capital gains distributions are passed to shareholders. By holding broad market index funds, investors not only reduce fees, but also minimize the drag from taxes. It is a double advantage. Taxes also affect decision-making. Investors often panic during downturns, selling stocks at a loss, and then facing tax consequences. Or they try to time the market, which creates multiple taxable events. Both strategies reduce net returns. Understanding taxes as part of investment costs helps investors make better, more rational decisions. The lesson is clear. A dollar lost to taxes is as damaging as a dollar lost to fees or poor management. Successful investing is not just about returns before taxes. It is about returns you actually keep. Any strategy that ignores this reality is incomplete and risky. Bogle also highlights the psychological effect. Many investors underestimate the long-term impact of taxes because they are abstract and invisible compared to fees. But over decades, the effect compounds dramatically. By planning for taxes, choosing tax-efficient funds, and minimizing unnecessary transactions, investors preserve a larger portion of the market's growth. And here is the connection to the next principle. Even after understanding costs and taxes, investors may face periods when the market itself is not growing or is in decline. Markets are cyclical. Booms end. Crashes occur. How should an investor respond when the good times no longer roll? In Chapter 9, Bogle explores when the good times no longer roll and explains how patience and discipline continue to protect wealth through market downturns. Chapter 9. When the good times no longer roll. Markets are not always friendly. They rise, but they also fall. Booms end, bubbles burst, and recessions arrive. John Bogle reminds us that even the most disciplined investors will face periods when the stock market disappoints. The good times will not roll forever, and the challenge lies not in predicting downturns, but in surviving them without panic. Investors often confuse short-term volatility with permanent loss. When prices drop sharply, fear takes over. People sell at the bottom, locking in losses that could have been temporary. Conversely, during exuberant booms, they buy at high prices, only to see markets correct. Emotional reactions transform a long-term winner's game into a personal loser's game. Bogle emphasizes that the market's history is cyclical. There are crashes, depressions, and periods of stagnation. Yet, over the long run, the market has always recovered and grown. Understanding this is key. Temporary setbacks are part of the journey, not the destination. Rational investors embrace this reality instead of fearing it. One strategy to survive downturns is diversification. Owning a broad mix of companies, sectors, and even bonds can reduce the impact of any single failure. Another strategy is patience. Those who remain invested during rough patches allow compounding to continue working in their favor. Selling during a downturn often guarantees that investors miss the recovery. Bogle also points out the importance of asset allocation. A balanced mix of stocks and bonds, aligned with your risk tolerance and time horizon, provides stability. Stocks offer growth over time, but bonds act as a buffer during turbulence. By keeping this balance, investors can navigate downturns with confidence and avoid emotional mistakes. Another crucial lesson is ignoring the noise. Financial media often amplifies short-term swings, using sensational headlines to create fear or excitement. Rational investors focus on the long term, not daily market chatter. The market is a reflection of business growth, not a source of constant drama. Staying calm and disciplined protects wealth. Finally, Bogle reminds us that downturns are not just challenges, they are opportunities. When prices fall, dividends can be reinvested at lower costs, compounding wealth more efficiently. Those who panic miss this advantage. The good times eventually return, and investors who stay the course benefit from the full recovery. As we move forward, this raises an important question. If the market grows over the long term, but short-term fluctuations confuse and scare many, how should an investor approach the selection of individual winners? Is it possible to pick funds or stocks that consistently outperform over decades? In Chapter 10, Bogle explores selecting long-term winners and explains why this pursuit is far trickier than it seems. Chapter 10. Selecting long-term winners. Investors often dream of finding the next Apple, the next Google, or a fund that consistently beats the market. The idea of picking long-term winners is alluring. It feels like a shortcut to wealth. But John Bogle warns that this pursuit is far more difficult than it appears. History shows that very few investors, and even fewer professional fund managers, can consistently identify long-term winners. The odds are stacked against anyone trying to outperform the broad market. Bogle emphasizes that past performance is misleading. A fund or stock that has performed exceptionally well for 5 or 10 years may not repeat that success. Market conditions change, industries evolve, and management teams shift. Predicting which companies or funds will continue to excel decades into the future is almost impossible. Even experts with access to the best information often fail. Another challenge is cost. Funds that promise high returns often charge high fees. The higher the cost, the more the investor must outperform simply to break even. This is the trap many fall into. Chasing apparent winners while ignoring fees is a recipe for disappointment. Bogle stresses that low-cost broad market exposure often beats high-cost attempts to pick individual winners over time. Bogle also discusses the psychological challenge. Investors are prone to overconfidence. They assume they can identify trends or predict market movements. But this overconfidence often leads to buying at peaks and selling at lows. In contrast, long-term wealth comes from consistency, patience, and minimizing unnecessary risks rather than trying to outsmart the market. The lesson is simple but counterintuitive. Instead of hunting for winners, investors should own the entire market through low-cost index funds. By doing so, they automatically participate in the success of thousands of companies without risking disproportionate exposure to any single failure. Broad ownership reduces risk, maximizes compounding, and avoids the pitfalls of trying to pick winners. History confirms this strategy. Active management may occasionally beat the market in the short term, but over decades, very few funds outperform after costs and taxes. Investors who remain disciplined, focused on low costs, and committed to long-term ownership consistently capture the majority of market returns. This understanding naturally leads to another important concept: reversion to the mean. Over time, extraordinary performance tends to return to average. The market has a way of correcting extreme highs and lows. Recognizing this principle is key to avoiding the temptation to chase short-term winners. In Chapter 11, Bogle explores reversion to the mean and why it reinforces the case for disciplined, long-term investing. Chapter 11. Reversion to the mean. In investing, nothing stays extraordinary forever. John Bogle introduces the concept of reversion to the mean, a simple yet powerful principle. Over time, returns that are unusually high or unusually low tend to move back toward the average. Stocks, funds, and markets rarely continue their extreme performance indefinitely. Understanding this concept is essential for patient, rational investors. Consider a fund that has outperformed the market for 5 years in a row. Many investors rush in, hoping to ride the wave of success, but Bogle warns that extreme performance is often temporary. Markets fluctuate, industries change, and winners of today may struggle tomorrow. By chasing past success, investors expose themselves to the risk of entering at the peak, only to experience underperformance later. This principle also explains why long-term index investing works. While some funds or stocks may temporarily lead the pack, over decades, most revert to the average performance of the market. By owning the entire market through low-cost index funds, investors capture the steady growth of all businesses rather than betting on fleeting stars. This avoids the costly mistakes of chasing outliers. Reversion to the mean also applies to losses. Just as extreme winners eventually moderate, extreme underperformers often recover over time. Companies that face temporary setbacks may regain strength. By holding a diversified portfolio, investors can benefit from this natural correction without trying to predict which individual stocks will rebound. Bogle emphasizes patience as the key to benefiting from reversion. Investors must resist the temptation to react to short-term extremes. Avoid buying hot funds at their peak and selling losing funds in panic. Instead, remain committed to a low-cost, diversified, long-term strategy. By doing so, reversion to the mean works in your favor, smoothing out volatility and reinforcing steady growth. The psychological impact is profound. Understanding that extremes are temporary reduces anxiety during market swings. It prevents emotional decision-making and encourages disciplined investing. Investors learn to view short-term fluctuations as noise, not signals. The market's long-term trend, built on the growth of businesses, is what truly matters. And this brings us to an important question. If the best strategy is to hold the market and avoid chasing past winners, do we even need advisors to pick funds for us? Many investors pay significant fees for advice that often does not improve results. In Chapter 12, Bogle explores seeking advice to select funds and explains when guidance is truly valuable and when it is unnecessary. Chapter 12. Seeking advice to select funds. Investors often wonder if they need expert advice to succeed. Financial advisors promise guidance, fund recommendations, and strategies that can supposedly beat the market. John Bogle challenges this notion, asking a simple question. If the majority of advisors cannot consistently outperform the market, is paying for advice really worth it? Bogle explains that most advisory services focus on selecting active funds. They recommend the hottest funds, highlight recent winners, and sell the idea of beating the market. Yet, as we have learned, past performance is not predictive, costs matter, and reversion to the mean ensures that today's winner may underperform tomorrow. Paying for advice in this context often reduces net returns rather than increasing them. That is not to say advisors have no value. For some investors, professional guidance can provide discipline, reassurance, and a structured investment plan. Advisors can help individuals avoid emotional mistakes, maintain long-term focus, and diversify portfolios appropriately. Their greatest contribution is often behavioral coaching, not stock picking. Bogle stresses that the most effective investors do not rely on complex strategies or frequent trades. They focus on simplicity, low-cost index funds, broad diversification, reinvesting dividends, and long-term discipline. Advice that encourages deviation from this approach is often costly and counterproductive. Investors must evaluate whether the fees they pay are truly adding value or simply creating an illusion of control. Another important consideration is transparency. Many advisory fees are hidden in fund expenses, trading commissions, or other charges. Investors may believe they are paying for expertise, but in reality, the fees themselves erode returns. Bogle's principle is clear. If you cannot measure value, you are likely overpaying for it. For most investors, the optimal strategy is straightforward. Select low-cost index funds, maintain proper asset allocation, and stay invested for the long term. Seeking advice should not involve chasing performance or paying for market timing. The real benefit of an advisor is to keep you disciplined, patient, and focused on proven principles. This understanding naturally leads to a broader lesson about investment philosophy. If simplicity, discipline, and low costs are the keys to long-term success, then embracing a lifestyle of restraint and efficiency in investing becomes crucial. In Chapter 13, Bogle explains how investors can profit from the majesty of simplicity and parsimony, making wealth accumulation both practical and powerful. Chapter 13. Profit from the majesty of simplicity and parsimony. In the world of investing, complexity is often mistaken for intelligence. Many investors are attracted to elaborate strategies, exotic funds, and constant market analysis. John Bogle challenges this mindset, emphasizing the majesty of simplicity. True investment success is rarely achieved through clever tricks or frequent trading. It comes from keeping things simple, minimizing costs, and practicing parsimony. Simplicity means focusing on what truly matters. Own the market broadly. Use low-cost index funds. Reinvest dividends. Stay invested for the long term. Avoid chasing hot funds or market timing schemes. These principles are straightforward, yet their power is immense. Complexity may give the illusion of control, but in reality, it often leads to mistakes and reduced returns. Parsimony is the art of restraint. Every fee, every unnecessary trade, and every tax is a small leak in the investor's wealth bucket. By carefully controlling costs and avoiding unnecessary risks, investors allow the natural growth of businesses to work fully in their favor. This disciplined approach transforms modest savings into substantial wealth over decades. Bogle also emphasizes patience as part of parsimony. The temptation to react to market swings, to sell in fear, or to buy in greed is constant. Parsimonious investors resist these urges. They trust the power of compounding, the reliability of business growth, and the value of time in the market. Their focus is on what they can control, not on the unpredictable noise of daily prices. Simplicity and parsimony also reduce stress. Investors who do not obsess over picking winners or timing the market experience less anxiety. Their strategy is clear, measurable, and repeatable. They know that wealth accumulation is a long journey, not a series of short-term victories. This clarity of purpose makes investing not only profitable, but mentally sustainable. Bogle uses historical evidence to reinforce his point. Over decades, broad, low-cost index funds have consistently outperformed most actively managed funds. The pattern is simple. Costs matter, patience pays, and diversification protects. There is no need for complexity when the fundamentals work reliably. As this chapter closes, we see that investing can be both elegant and effective. By embracing simplicity and parsimony, investors maximize returns while minimizing risk, cost, and stress. But simplicity alone is not enough. Bonds, the other major asset class, play a critical role in stabilizing portfolios. In Chapter 14, Bogle explores bond funds and how they fit into a balanced investment strategy. Chapter 14. Bond funds. While stocks provide growth, bonds provide stability. John Bogle emphasizes that a well-balanced investment strategy requires both. Bonds are essentially loans to governments or corporations, and they pay interest over time. They do not offer the excitement of stocks, but they protect investors from the volatility of the market and reduce overall risk in a portfolio. Bond funds pool many individual bonds, allowing investors to diversify without buying each bond separately. This diversification is crucial because individual bonds carry default risk. A bond fund spreads the risk across many issuers, industries, and maturities. The result is a smoother return stream and reduced exposure to any single failure. Bogle points out that bonds are especially important for investors with shorter time horizons or lower risk tolerance. While stocks can rise dramatically over decades, they can also fall sharply in the short term. Bonds act as a cushion, providing income and stability when markets are turbulent. They allow investors to sleep at night, knowing that part of their portfolio is less sensitive to daily market swings. Interest rates affect bond prices, and Bogle explains the importance of understanding duration. Longer-term bonds are more sensitive to interest rate changes, while shorter-term bonds provide more stability but lower yields. Investors should choose bond funds that match their goals, time horizon, and risk tolerance. Another key concept Bogle highlights is that bonds complement the power of compounding. While stocks drive growth, bonds provide consistent income that can be reinvested. This combination strengthens long-term portfolios and balances risk, especially for those nearing retirement. However, Bogle warns against overcomplicating bond investing. Many investors chase exotic bond funds, high yields, or complex strategies. Often, the results do not justify the added risk or cost. A simple, diversified bond fund is usually sufficient to provide stability and predictable returns. Finally, Bogle emphasizes that asset allocation, the balance between stocks and bonds, is personal. It should reflect each investor's goals, risk tolerance, and time horizon. Bonds are not a substitute for growth, but they are a vital stabilizing component in a long-term investment plan. With bonds in place, investors can also explore another modern tool: exchange-traded funds, or ETFs. ETFs combine the benefits of low-cost investing with flexibility and liquidity. In Chapter 15, Bogle explores the exchange-traded fund, ETF, and its role in a balanced, disciplined portfolio. Chapter 15. The Exchange-Traded Fund, ETF. In the evolving world of investing, ETFs have emerged as a powerful tool for individual investors. John Bogle explains that ETFs combine the best features of mutual funds and stocks. They offer broad diversification, low costs, and flexibility in trading, making them an attractive option for disciplined investors. An ETF is a fund that holds a basket of stocks or bonds and trades on an exchange like a stock. This means investors can buy and sell shares throughout the trading day at market prices. Unlike traditional mutual funds, which trade only once per day at net asset value, ETFs provide instant liquidity and transparency. Investors can see the price, enter or exit positions, and manage their portfolios efficiently. Bogle highlights that ETFs are particularly useful for low-cost, passive investing. Many ETFs track market indexes, mirroring the performance of the S&P 500, total stock market, or bond indexes. This allows investors to capture market returns without paying the high fees associated with actively managed funds. ETFs can also be combined with automatic reinvestment plans to harness the power of compounding, just like traditional index funds. Despite their advantages, Bogle cautions against using ETFs as speculative tools. The flexibility of trading may tempt investors to try market timing or chase short-term gains. This defeats the purpose of a disciplined, long-term investment plan. ETFs should be seen as instruments for steady, patient growth, not as vehicles for gambling on market fluctuations. Another important point Bogle makes is tax efficiency. ETFs are structured in a way that minimizes capital gains distributions. This means investors keep more of the market's growth compared to actively managed funds, which often generate frequent taxable events. Low costs and tax efficiency make ETFs a natural choice for long-term portfolios. Finally, Bogle notes that ETFs are not a replacement for the principles of investing. They are a tool, not a strategy. The real focus remains on diversification, low costs, reinvesting returns, and staying invested over the long term. When used wisely, ETFs support these principles effectively. This discussion naturally leads to the next caution. Not all index funds or ETFs are created equal. Some claim to beat the market with special strategies, higher fees, or marketing promises. In Chapter 16, Bogle examines index funds that promise to beat the market, explaining why skepticism and simplicity are often wiser than chasing gimmicks. Chapter 16. Index funds that promise to beat the market. In the investment world, many funds claim they can consistently outperform the market. John Bogle warns that these promises are usually misleading. Index funds, by design, aim to match market performance, not beat it. Claims of guaranteed outperformance often come with hidden costs, higher fees, and increased risk that eat away at returns. Bogle emphasizes that the market itself is a reflection of all businesses and all investors combined. Beating it consistently over decades is extremely difficult. Even professional fund managers rarely succeed, and those who do often have luck, not skill, on their side. Investors who chase these beating the market funds are exposed to high fees and often poor long-term results. High-cost funds that promise exceptional returns are especially problematic. Marketing and hype attract investors, but the reality is stark. The fund must outperform not only the market, but also cover its own fees and expenses. Over time, these costs compound against the investor. What seems like an exciting opportunity often ends as a slow erosion of wealth. Bogle also notes the psychological trap. Investors are drawn to stories of spectacular gains. They believe that clever strategies, insider knowledge, or active management will deliver extraordinary results. But chasing past performance is a losing game. Reversion to the mean ensures that today's winners may underperform tomorrow. Low-cost, broad-based index funds provide a more reliable path to long-term wealth. Another important point is transparency. Many beat-the-market funds are opaque about costs, turnover, and strategy. Investors may not realize how much of their return is consumed by fees until it is too late. Simplicity, clarity, and cost efficiency, as offered by traditional index funds, protect investors from these hidden drains. Bogle stresses that the lesson is timeless. Investors should focus on what is proven, measurable, and within their control. Low costs, broad diversification, reinvested dividends, and long-term discipline. Chasing gimmicks and promises of beating the market is a distraction, often costly both financially and emotionally. Understanding this leads naturally to a historical perspective. If Bogle had followed the principles of Benjamin Graham, the father of value investing, how would he have viewed index funds and passive investing? In Chapter 17, Bogle explores what would Benjamin Graham have thought about indexing, and connects timeless investment wisdom to modern practices. Chapter 17. What would Benjamin Graham have thought about indexing? Benjamin Graham, often called the father of value investing, emphasized discipline, rational analysis, and long-term thinking. John Bogle reflects on what Graham might have thought about index investing. While Graham focused on finding undervalued stocks, Bogle argues that the core principles align closely with low-cost passive investing. Graham believed in investing with a margin of safety, avoiding speculation, and focusing on fundamentals. Index funds, while not selecting individual stocks, embody the same spirit by providing broad exposure to the market, minimizing risk through diversification, and avoiding the uncertainty of predicting winners. Investors get the full benefit of business growth while limiting unnecessary risks. Bogle suggests that Graham would likely appreciate the efficiency of indexing. It is systematic, disciplined, and low cost. It avoids the pitfalls of frequent trading, market timing, and speculative bets that Graham warned against. In essence, indexing provides a practical way to follow Graham's timeless principles without relying on luck or trying to outguess the market. Moreover, Graham emphasized the importance of patience and long-term perspective. Indexing requires the same mindset. Short-term market fluctuations are irrelevant to the disciplined investor. Over decades, the combined growth of businesses, dividends, and compounding rewards those who remain invested. Graham's philosophy of rationality and caution is fully compatible with the passive approach. Another point Bogle makes is that Graham encouraged minimizing costs. Every unnecessary expense or speculative bet reduces the investor's margin of safety. Index funds excel in this area, offering minimal fees and tax efficiency. Investors keep more of what the market produces, staying true to the principle of disciplined wealth accumulation. Bogle concludes that Graham's wisdom is timeless. While Graham selected stocks individually, the underlying philosophy, patience, discipline, diversification, and cost consciousness, is the foundation of successful indexing. By following these principles, investors can achieve growth, protect wealth, and avoid the common mistakes that derail most active strategies. This naturally leads to a broader question. How should investors allocate their wealth between stocks and bonds to balance growth and risk? In Chapter 18, Bogle explains asset allocation stocks and bonds, providing practical guidance on building a portfolio suited to long-term success. Chapter 18, Asset Allocation. Stocks and bonds. Investing is not just about picking funds or stocks. John Bogle emphasizes that one of the most important decisions an investor makes is asset allocation. How much of a portfolio is invested in stocks versus bonds? This allocation largely determines risk, return, and long-term success. Stocks offer growth. They represent ownership in businesses and participate in profits, dividends, and appreciation. Bonds, on the other hand, provide stability. They pay interest and are less volatile than stocks. By balancing these two asset classes, investors can achieve a mix of growth and protection suited to their goals and risk tolerance. Bogle stresses that there is no perfect allocation for everyone. Younger investors with long-time horizons may hold more stocks, accepting short-term volatility for higher long-term growth. Older investors, or those nearing retirement, may shift toward bonds to preserve capital and generate steady income. The key is aligning allocation with individual circumstances rather than chasing trends. Diversification within each asset class is also crucial. Broad stock indexes reduce company-specific risk, while diversified bond funds lower default risk. A portfolio built with both stocks and bonds, each diversified, ensures that investors are not overly exposed to any single risk. This combination smooths returns over time and reduces emotional stress during market swings. Another principle Bogle highlights is rebalancing. Markets shift daily, and over time, the portfolio's stock-to-bond ratio may drift from the target. Periodic rebalancing, selling assets that have grown above target and buying those below, restores balance. This simple discipline maintains risk levels and enhances long-term results. Bogle also cautions against overcomplicating asset allocation. Some investors chase exotic strategies, commodities, or alternative investments, thinking they will improve performance. History shows that broad exposure to stocks and bonds, kept simple and low cost, often outperforms complex strategies over decades. Finally, Bogle notes that asset allocation is not static. Life circumstances, risk tolerance, and goals change. The investor who monitors their allocation periodically and adjusts prudently will navigate market volatility more effectively, remain disciplined, and achieve consistent long-term growth. With the foundation of stocks and bonds set, the next chapter expands the concept further. In Chapter 19, Bogle explores asset allocation terms, diving deeper into fine-tuning portfolios, risk management, and long-term planning. Chapter 19, Asset Allocation 2. Building on the basics of stocks and bonds, John Bogle delves deeper into fine-tuning asset allocation. Asset allocation is not just a simple split between stocks and bonds. It is a dynamic tool that balances risk, reward, and long-term objectives. Proper allocation is the single most important determinant of portfolio performance. Bogle emphasizes that asset allocation should reflect personal circumstances, age, risk tolerance, income needs, and financial goals. A young investor can afford to be more aggressive, holding a higher proportion of stocks for growth. A retiree, on the other hand, requires stability and income, favoring bonds and low volatility assets. The key is tailoring allocation to the investor's situation, rather than following generic advice. Diversification is the next layer of security. Within stocks, spreading investments across large, medium, and small companies, as well as different sectors and geographies, reduces concentration risk. Within bonds, mixing government and corporate bonds of various durations balances yield with stability. This broad diversification ensures that no single economic event or market swing disproportionately affects the portfolio. Bogle also highlights the importance of rebalancing discipline. Over time, market movements can shift your allocation away from the target. Stocks may grow faster than bonds, increasing portfolio volatility. Periodic rebalancing, selling what has overgrown and buying what has lagged, restores balance, reduces risk, and enforces a buy low, sell high discipline. Another principle Bogle underscores is simplicity and cost efficiency. Investors may be tempted to use complex strategies, hedge funds, or alternative investments. However, studies show that low-cost, broadly diversified portfolios outperform most complex strategies over the long term. Complexity often increases costs and reduces net returns without adding significant advantage. Bogle also considers the psychological dimension. Proper allocation reduces anxiety during market swings. Knowing that your portfolio is structured according to risk tolerance and long-term objectives allows investors to avoid panic selling during downturns and greed-driven overbuying during booms. Emotional discipline is easier when allocation is aligned with goals. Finally, Bogle emphasizes that asset allocation is not a one-time decision. Life circumstances, market conditions, and goals evolve. Reviewing and adjusting allocations periodically ensures that your portfolio remains aligned with your objectives, allowing steady progress toward financial security. With asset allocation carefully structured, the next step is to consider the broader perspective on investment advice. In Chapter 20, Bogle discusses investment advice that meets the test of time, providing timeless guidance for consistent, long-term investing success. Chapter 20, Investment Advice that Meets the Test of Time. In a world crowded with financial experts, hot tips, and constant market predictions, John Bogle reminds investors of one timeless truth. The best investment advice is simple, practical, and proven over decades. It does not rely on speculation, hype, or chasing trends. Instead, it focuses on disciplined, low-cost, long-term strategies that stand the test of time. Bogle emphasizes 4 pillars of enduring investment advice. First, focus on low-cost investing. Every rupee spent on fees, commissions, or unnecessary trading reduces returns. Minimizing costs is one of the most powerful ways to enhance long-term performance. Second, embrace diversification. Broad exposure to the market reduces the risk associated with any single company, sector, or region. Diversification ensures steady growth while minimizing volatility, allowing investors to benefit from the market's overall upward trajectory. Third, maintain patience and discipline. time in the market is far more important than timing the market. Investors who stay invested, reinvest dividends, and avoid emotional reactions to short-term fluctuations capture the power of compounding and long-term growth. Fourth, align investments with personal goals and risk tolerance. There is no universal portfolio. The right allocation between stocks and bonds, the choice of index funds, and the level of exposure to risk depend on individual circumstances. Following a plan tailored to personal objectives reduces anxiety and prevents impulsive decisions. Bogle also cautions against over-reliance on advisors or chasing exotic strategies. True, advisors can offer behavioral coaching and structure, but the value lies in reinforcing these timeless principles, not in promises of beating the market. Most actively managed funds fail to outperform after costs and taxes, reinforcing the power of simple, disciplined investing. The essence of advice that passes the test of time is simplicity, cost consciousness, and long-term focus. Complicated strategies, frequent trading, and market timing are often distractions that reduce net returns. Investors achieve lasting success by keeping the approach straightforward, measurable, and aligned with enduring principles. Finally, Bogle encourages investors to think beyond immediate gains. Wealth accumulation is a marathon, not a sprint. Discipline, low costs, broad diversification, and long-term perspective consistently reward those who adhere to these principles. Having covered the fundamentals, Bogle closes the book with acknowledgments, recognizing the contributors, mentors, and thinkers whose wisdom shaped his philosophy. In Chapter 21, he expresses gratitude while reaffirming the enduring power of common sense investing and the principles that guide every successful investor. Chapter 21, Acknowledgments. John Bogle closes the little book of common sense investing by expressing gratitude to the many people who influenced his thinking and supported his work. He acknowledges mentors, colleagues, family, and the countless investors whose questions, experiences, and feedback shaped his philosophy. Bogle emphasizes that investing is not a solo journey. The ideas in this book reflect decades of learning from experience, observation, and collaboration. He thanks the leaders and thinkers in the financial world who demonstrated integrity, discipline, and a focus on the long term, reinforcing the principles he shares with readers. He also recognizes the countless individual investors who have applied these ideas, proving that simple, low-cost, disciplined investing works over decades. Their successes and struggles provided invaluable lessons that shaped the book's guidance. Finally, Bogle thanks his family for their support and patience, understanding the demands of building an investment philosophy and running a pioneering financial institution. Their encouragement allowed him to focus on his work, research, and advocacy for investors' interests. Bogle concludes with a reminder that investing is not about luck or short-term speculation. It is about patience, discipline, and adherence to timeless principles. Acknowledging those who contributed to the journey reinforces the core message of the book. Investing with integrity, simplicity, and focus leads to lasting financial success. This closes the journey of The Little Book of Common Sense Investing, leaving readers with a clear, actionable framework. Minimize costs, diversify broadly, stay patient, and always focus on long-term wealth accumulation. Conclusion. We have now traveled through the wisdom of John Bogle, learning the timeless principles of successful investing. From understanding market cycles, focusing on low-cost index funds, embracing diversification, and practicing patience, to balancing stocks and bonds and avoiding the traps of speculation, this book shows that common sense is the most powerful tool in investing. The message is simple yet profound. Wealth is not built through shortcuts, hype, or chasing winners. It grows steadily when we minimize costs, remain disciplined, invest broadly, and stay focused on the long term. Bogle's philosophy reminds us that investing is not a gamble. It is a journey where consistency, simplicity, and patience are the keys to success. Remember, the markets will have ups and downs. The good times may not always roll, and short-term losses are inevitable. But by following these principles, investors position themselves to ride the waves, benefit from compounding, and achieve lasting financial growth. If you found this summary valuable, and you want more insights, detailed book summaries, and practical tips to grow your wealth and sharpen your financial understanding, subscribe to the channel. Hit the notification bell so you never miss an update, and join our community of smart, disciplined, and forward-thinking investors. Your journey to financial wisdom begins with knowledge, and applying it consistently is the path to freedom and security. Start today, stay disciplined, and let the power of common sense investing work for you.